Let me tell you something I learned the hard way in this business of speculation. A man does not come to the market to prove he is clever. The market has a way of humiliating clever men. A man comes to the market to learn how to wait, how to read the tape, and how to keep his money when the odds are poor. Now you may have heard people say you can become profitable in 30 days. That sounds like a bold promise, doesn't it? But let me put it to you plainly. The 30 days are not about beating the market. They are about learning not to beat yourself. You see, most traders lose money not because the market is mysterious, but because they are impatient. They rush in where there is nothing to be done. They trade when the market is whispering instead of when it is shouting. Have you ever opened a chart and felt the urge to take a trade simply because you were staring at the screen? Of course you have. Every beginner does. I did the same thing when I started reading the tape in bucket shops many years ago. I thought activity meant opportunity. It does not. The first lesson a trader must learn in those 30 days is this: the market pays you for patience. Not for prediction, not for excitement, for patience. When you study a chart, you are not looking for something to do. You are looking for something that cannot be ignored. A price level that the market respects. A trend that continues day after day like a river flowing downhill. Do you think fortunes are made by guessing every wiggle on a chart? No, sir. Fortunes are made by recognizing when the market has made up its mind, and then sitting tight. Now consider this carefully. If a trader wishes to become profitable, even within 30 days, the first habit he must develop is capital preservation. That means learning how to lose correctly. Strange advice, isn't it? Yet it is the most important advice in speculation. A trader who refuses small losses will soon face a very large one. Suppose you enter a trade because the chart shows a clear breakout. The price moves against you instead of confirming your idea. What do? Many traders argue with the market. They add to the losing position. They convince themselves the market is wrong. But tell me, have you ever known the market to apologize? Neither have I. The professional does something different. He steps aside. He closes the trade quickly and keeps his capital intact. Because the professional knows there will always be another opportunity tomorrow. That is how a trader survives long enough to become profitable. During your first 30 days, you must train your eyes to see structure in price. Markets move in trends. Uptrends, downtrends, and periods of dull sideways movement where nothing worthwhile happens. Yet the inexperienced trader tries to trade all three. Why? Because he feels he must always be doing something. But let me ask you something. If a fisherman casts his line into an empty pond, does patience alone bring him fish? Of course not. He must first find the water where the fish actually live. Trading is no different. Your charts will show you where money is flowing. When a market trends strongly upward, it means buyers are willing to pay higher prices. When it trends downward, sellers are pressing their advantage. The trader who becomes profitable is the one who aligns himself with that pressure instead of fighting it. That is the essence of speculation. Now another mistake many traders make during their early days is believing that more trades mean more profit. That idea will empty your account faster than anything else. I have seen men trade themselves into ruin simply because they could not sit still. The big money is never made in constant trading. It is made in the waiting. You watch the chart. You observe how price reacts to certain levels. Support, resistance, breakouts, consolidations. Day after day you watch, and eventually the market begins to reveal its personality. Have you noticed how certain price levels act like walls? Price approaches them again and again, testing them. Sometimes the level holds. Sometimes it breaks violently. Those moments matter. Those are the moments a trader prepares for. When a breakout occurs after a long consolidation, the market is telling a story. It is telling you that pressure has been building beneath the surface. Buyers and sellers have been wrestling for control, and finally one side has won. Now the inexperienced trader often jumps in too late, chasing the move. But the thoughtful trader studies the chart beforehand. He identifies the level where the breakout might occur. He waits quietly. When the market confirms the move, he acts without hesitation. But even then, he controls his risk. That is the trader's mindset you must build in 30 days, not excitement, not greed, control. You must also understand position size. Many beginners risk far too much on a single trade because they are eager to grow their account quickly. That impatience destroys them. A trader who risks 5 or 10% of his capital on one trade is gambling, not speculating. The wise trader risks only a small fraction, small enough that a loss is merely a scratch, not a wound. Because the goal is survival. Think of it this way. If you lose half your capital, you must make 100% just to return to where you started. That is a difficult climb. But if you lose only 1%, the road ahead is still smooth. So in your first 30 days, your greatest victory may not be making money. It may simply be keeping your account intact. And as you study your charts day after day, something interesting begins to happen. Patterns start appearing where once you saw chaos. You begin to recognize accumulation. Those quiet periods where smart money builds positions slowly. You see distribution, where that same smart money begins to unload. Have you ever wondered why markets sometimes move sharply after long, quiet periods? That is not random. That is preparation meeting opportunity. When you understand this, your trades become fewer but better. You stop reacting emotionally to every candle on the chart. Instead, you observe the broader movement of price, the trend, the volume, the behavior around key levels. That is when your confidence begins to grow, not because you believe you can predict the market, but because you understand how to respond to it. And the trader who responds correctly, who cuts losses quickly, lets profits run, and waits patiently for clear opportunities, is already miles ahead of the crowd. But here is something few people tell you about becoming profitable in 30 days. The greatest challenge is not learning charts. It is mastering yourself, because the market will test your discipline every single day. It will tempt you with impulsive trades. It will frighten you out of good positions. It will make you doubt your plan at exactly the wrong moment. And unless you develop the calm mindset of a professional, those emotions will sabotage your results. So every day you must practice restraint. You must watch the market without feeling compelled to act. You must accept that missing a trade is far better than forcing a bad one. And slowly, almost without noticing, your trading begins to change. You become selective. You wait for the moments when the odds lean clearly in your favor. And when those moments arrive, you act with quiet confidence. But before a trader can truly reach that stage, there is another principle he must understand about price movement. When a man first comes into the market, he believes the secret lies in prediction. He studies charts, listens to opinions, reads forecasts, and thinks that if he can only guess tomorrow's price correctly, the money will follow. I have seen that belief in thousands of traders over the years. Perhaps you have felt it yourself. You look at a chart and ask, where will price go next? It seems like the most important question in trading, doesn't it? But the truth is quite different. Profitability begins with discipline, not prediction. The market has a peculiar habit of humbling the man who believes he can outsmart it. You may predict correctly once, twice, even several times in a row, and still lose money. That confuses beginners. They say, but I was right about the direction. And yet their account shrinks. How can that be? Because being right about direction and being profitable are two entirely different things. A trader without discipline cannot hold a winning position long enough to benefit from it. He takes profits too early because he fears the market will take them back. Then, when he is wrong, he refuses to exit the trade because he hopes the market will turn around. Have you ever noticed how easy it feels to close a winning trade quickly, yet how difficult it is to close a losing one? That is not strategy. That is human nature. Discipline is the force that corrects this natural tendency. It is the quiet rule a trader follows even when his emotions argue against it. When the market proves him wrong, the disciplined trader steps aside without hesitation. No drama, no arguments, just action. You see, the market does not care about opinions. It only reflects supply and demand. When price moves against your position, the market is telling you something very simple: your timing is wrong, or your idea is wrong. Either way, the disciplined trader respects that message. Many traders imagine that professionals win because they are better predictors. In reality, the professional wins because he manages risk better. He knows that every trade contains uncertainty. Even the most beautiful chart pattern can fail. The breakout that looks perfect can reverse without warning. So what does the disciplined trader do? He prepares for that possibility before he ever enters the trade. He decides where he will exit if the trade proves incorrect. Not after the loss begins to grow, but before the trade is even placed. That decision protects his capital. Without that protection, prediction becomes dangerous. Let me ask you something. If a trader risks half his account on one prediction, what happens when the market surprises him? His trading career ends quickly. But if the same trader risks only a small portion of his capital, the outcome changes entirely. A loss becomes manageable. The account survives, and survival is the first requirement of success in speculation. During your first weeks of trading, discipline will feel uncomfortable. Your mind will constantly suggest new trades, new predictions, new ideas. The market will move rapidly, and you will feel the urge to jump in simply because something is happening. But activity alone does not produce profit. The disciplined trader learns to wait. He observes price movements calmly. He studies how the market behaves around key levels: support, resistance, trends, consolidations. Instead of guessing every move, he waits for confirmation. Have you ever watched a chart where price repeatedly tests a certain level, almost as if it is gathering strength? That moment matters. When price finally breaks through with conviction, it often signals that buyers or sellers have taken control. The undisciplined trader chases that movement impulsively, often too late. The disciplined trader planned for it beforehand. He identified the level. He prepared his entry. He calculated his risk. That difference may appear small, but it changes everything. Prediction is uncertain. Discipline is controllable. You cannot command the market to move in your favor. No trader can. But you can control how much you risk, when you enter, and when you exit. Those choices determine your long-term survival. Many traders spend years searching for a perfect indicator, a flawless strategy, a magical formula that predicts the market with precision. Yet the real advantage often lies somewhere far simpler. It lies in consistent behavior. The trader who follows his rules day after day develops stability in his results. Losses remain small. Profits are allowed room to grow. Over time, that balance begins to tilt in his favor. Without discipline, even the best strategy collapses. With discipline, even a simple strategy can produce steady results. And that realization marks the moment when a trader begins to think less like a gambler and more like a professional speculator. Because the disciplined trader understands something the crowd often ignores. The market will always remain unpredictable. One of the costliest habits a trader can develop is the desire to outguess the market. A man looks at a chart and thinks he sees the turning point before it happens. He says to himself, "Price has gone up long enough. Surely it must come down now." Or he sees a falling market and decides it has dropped too far, too fast, and must soon reverse. Have you ever caught yourself thinking that way? Most traders have. But the market does not reverse simply because it seems logical. It moves according to pressure, the steady push of buyers and sellers. When buyers dominate, price rises. When sellers dominate, price falls. It is not complicated, yet many traders ignore this simple fact because they wish to be clever. The wiser approach is far simpler. Align yourself with the trend. A trend is nothing mysterious. It is simply the direction in which price continues to move over time. Higher highs and higher lows form an uptrend. Lower highs and lower lows form a downtrend. The chart reveals it plainly if you are patient enough to observe it. Yet many traders still fight against it. Why would a man choose to stand in front of a moving train instead of riding along with it? Because predicting a reversal feels exciting. It gives the trader the illusion of brilliance. If he catches the exact turning point, he believes he has outsmarted the entire market. But speculation is not about impressing anyone. It is about making money consistently, and consistency rarely comes from fighting the prevailing direction. Consider what happens during a strong uptrend. Price advances steadily, sometimes pulling back briefly before continuing higher. Each pullback invites sellers to step in, thinking the move has ended. They sell against the trend, expecting the market to collapse. Yet what usually happens? The trend resumes, and those sellers are forced to buy back their positions at higher prices. Their losses become fuel for the next upward move. The trader who aligns himself with the trend understands this behavior. Instead of selling into strength, he waits for those temporary pullbacks. When price shows signs of stabilizing again, he enters in the direction of the larger movement. This does not require perfect timing. It requires patience and observation. Have you ever noticed how a strong trend tends to persist longer than most traders expect? A stock, currency, or commodity may rise for weeks or months, while countless traders attempt to call the top. Each time they predict the end, the market continues moving. That persistence is the very thing a disciplined trader seeks. The trend represents collective conviction. It shows where money is flowing. And in speculation, it pays to follow the flow rather than resist it. Now, this does not mean every trend lasts forever. Eventually, every market changes direction. But those changes reveal themselves through price behavior. The chart begins to show weakness. The higher highs disappear. The structure of the trend breaks. Until that happens, the trend deserves respect. Many beginners enter trades simply because price has moved quickly in one direction. They believe the move must soon reverse. Yet speed alone does not indicate exhaustion. Sometimes rapid movement means strength. Sometimes it means the market is only beginning its run. The chart tells the story if you listen carefully. A trader who studies trends also develops another valuable habit, selective trading. When the market moves sideways without clear direction, he avoids unnecessary trades. Sideways markets are full of noise and confusion. Breakouts fail. Reversals appear suddenly. But when a clear trend emerges, the environment changes. The market begins to reward trades that follow its direction. Have you ever looked back at a chart weeks later and noticed how obvious the trend seems in hindsight? At the time it may have felt uncertain. But once the movement unfolds, the path becomes clear. The goal of a trader is not to capture every small fluctuation. It is to recognize when a meaningful movement is underway and position himself accordingly. This requires humility, because aligning with the trend means accepting that the market knows more than you do. It means observing what price is actually doing rather than insisting on what it should do. The trader who learns this lesson stops arguing with the market. He stops predicting every reversal. Instead, he studies the rhythm of price, the advances, the pauses, the pullbacks, and gradually he begins to see that the safest trades often come from moving with the market's momentum rather than attempting to stand against it. Many traders believe success comes from finding the perfect indicator. They search endlessly for new systems, new signals, new strategies that promise better entries and better exits. One week they follow moving averages, the next week they try oscillators, and after that they experiment with some new method they saw someone mention online. Have you ever noticed how easy it is to keep changing strategies when results are disappointing? But here is something the market teaches: sooner or later tools do not control your decisions. Your mind does. Emotional control and the trader's mindset shape the quality of every decision you make in the market. A chart may give you a signal, but your reaction to that signal determines whether the trade helps you or harms you. Consider what happens when fear enters the picture. You enter a trade according to your plan. The setup looked clean, the trend was clear, and the risk was defined. But shortly after entering, the price begins to fluctuate slightly against you. Nothing unusual. Markets breathe like that. Yet fear begins whispering in your mind. What if this trade fails? What if the loss grows larger? Before long, that fear convinces you to exit the position prematurely. Moments later, the market resumes its original direction without you. The plan was sound, but emotion interrupted it. Now consider the opposite situation: greed. A trader sees a strong move on the chart. Price is rising rapidly, and the candles look exciting. He did not plan the trade, but he feels he might miss the opportunity. So he jumps in late, chasing the movement. Have you ever done that? Most traders have at some point. But the market has a strange sense of timing. The moment the emotional trader enters, The market pauses or pulls back. The move that looked unstoppable suddenly slows down. Now the trader is trapped in a poor position, not because the chart missiled him, but because emotion rushed his decision. Fear pushes traders out of good trades too early. Greed pushes them into bad trades too late. Both emotions weaken judgment. That is why the trader's mindset is more important than any indicator on the chart. The disciplined trader understands that emotions cannot be eliminated completely. After all, we are human beings, not machines. But emotions can be managed through structure and routine. A professional trader approaches the market with a plan already prepared. He knows where he intends to enter. He knows where his stop-loss belongs. He knows how much capital he is willing to risk. Those decisions are made before emotion has a chance to interfere. Once the trade begins, the plan does the thinking. Without that structure, every price movement becomes a psychological test. Each tick on the chart feels like a personal challenge. The trader begins questioning every decision. Should he close the trade? Should he add to it? Should he reverse direction? The market becomes stressful because the trader has no framework to guide him. But when a trader develops a strong mindset, his relationship with the market changes. Instead of reacting emotionally, he observes calmly. Price movements become information rather than threats. Losses are accepted as part of the business. No trader wins every trade. Even the most experienced professionals face losing positions regularly. The difference is that they do not allow those losses to disturb their discipline. They simply record the trade, review the decision, and move forward. Let me ask you something. If a trader allows one emotional mistake to trigger another, how long will his capital last? Not very long, because emotional trading rarely stops after one error. A loss creates frustration. Frustration encourages revenge trading. The trader attempts to recover the loss quickly by taking impulsive trades. Those trades often fail as well, creating even more pressure. Before long, the account suffers damage that could have been avoided with a calm mindset. The experienced trader recognizes these psychological traps. When emotions begin to rise, he slows down. Sometimes he even steps away from the market entirely for a while. A clear mind protects capital better than any complex strategy. This mindset also improves patience. A trader who controls his emotions does not feel compelled to trade every movement. He understands that the market offers endless opportunities over time. Missing one trade means nothing. That patience allows him to wait for higher probability setups. Those moments when the trend, price structure, and risk management align clearly. And when those moments arrive, the calm trader executes his plan without hesitation, because his decisions are not driven by excitement or fear, but by practiced discipline. One of the first illusions a trader must overcome is the belief that more trades lead to more profit. At first glance, it seems logical. If one good trade can produce profit, then taking many trades should multiply those gains. That idea attracts beginners because it feels productive. The trader sits in front of his charts all day, entering and exiting positions, believing he is working hard at his craft. But the market does not reward activity. It rewards judgment. Many traders slowly discover that the more they trade, the more their results become inconsistent. Small mistakes accumulate, commissions increase, emotional fatigue sets in. Before long, the account shows the damage caused by too much action and too little selectivity. Have you ever looked back at your trading history and noticed that a few good trades produced most of your profits? That observation appears again and again in speculation. A handful of high probability trades often generate the majority of a trader's success. The rest are usually small gains, small losses, or unnecessary risks that add little value. The experienced trader understands this pattern and adjusts his behavior accordingly. Instead of trying to capture every movement on the chart, he becomes selective. He studies the market quietly and waits for situations where the odds appear clearly favorable. These situations do not appear constantly. Sometimes the market moves in dull, sideways patterns where price offers no clear direction. During those times, the disciplined trader does something many beginners find difficult. He does nothing. Now that may sound strange to someone eager to grow an account, but waiting is part of the business. The market often spends long periods drifting without conviction. Prices move up and down in narrow ranges, trapping impatient traders who try to force opportunities where none exist. Do you think professional traders feel comfortable during those quiet periods? Of course they do, because they know the market cannot remain quiet forever. Pressure builds beneath the surface. Buyers accumulate positions. Sellers distribute their holdings. Eventually that balance breaks and price begins to move with purpose. Those are the moments the selective trader is waiting for. When a strong trend forms or a major price level breaks with conviction, the market finally offers a situation where probability improves. The structure of the chart becomes clearer. Risk can be defined more precisely. The potential reward becomes larger than the potential loss. That is when the professional acts. But notice something important. Even then, he does not suddenly become reckless. Selective trading is not about waiting endlessly and then risking everything on one opportunity. It is about choosing the best setups while still respecting risk management. A trader might take only a few trades in a week, sometimes even fewer, yet those trades are carefully chosen. The trend aligns with the setup. The entry level makes sense. The stop loss protects capital. Have you noticed how different that approach feels compared to constant trading? Instead of reacting impulsively to every candle on the chart, the trader becomes calm and deliberate. Each trade has a purpose. Each decision fits within a larger plan. This shift also improves emotional stability. When traders take too many trades, they experience rapid swings in results. A few losses in quick succession can create frustration and doubt. The trader begins chasing the next opportunity just to recover what was lost. But when trading becomes selective, each decision carries more thought and preparation. Losses still occur. They are unavoidable in speculation, but they no longer feel chaotic. They are simply part of a controlled process. Another advantage appears over time. Selective traders develop a deeper understanding of price behavior. Because they are not distracted by constant entries and exits, they spend more time observing the market itself. They study how price reacts at support and resistance levels. They watch how trends develop and how momentum builds. This observation sharpens judgment. The trader begins to recognize patterns more clearly. He learns which setups tend to succeed and which ones often fail. Experience accumulates in a meaningful way because it is focused on quality situations rather than scattered across hundreds of impulsive trades. Now let me ask you something. If a trader takes 50 random trades in a week, how much attention can he truly give to each one? Very little. But if he takes only a few carefully selected trades, each one becomes an opportunity to practice discipline, risk control, and patience. Over time, those habits strengthen. Consistent profitability rarely comes from speed or constant motion. It comes from clarity, recognizing when the market is offering a genuine opportunity and when it is simply producing noise. The trader who understands this begins to appreciate a quiet chart just as much as an active one, because a quiet chart gives him time to think, to plan, and to prepare for the moments when the market finally reveals a setup worth risking capital. A trader who studies charts long enough begins to notice something important. Price rarely moves randomly for long. Beneath all the noise, certain moments stand out, moments when the market clearly reveals strength or weakness. Those moments are where real opportunities appear. Yet many traders enter the market long before that confirmation arrives. They look at a chart and form an opinion immediately. Price looks cheap. They say so they buy. Or perhaps they think the market has risen too far, so they sell. Their decision is based on what they believe should happen, rather than what the market is actually showing. Have you ever taken a trade simply because you felt the price had gone far enough? That feeling is common, but the market does not move according to our feelings. It moves when pressure builds strongly in one direction. Buyers must prove their strength by pushing price higher. Sellers must prove their control by driving price downward. That proof appears on the chart. Consider a price level where the market has repeatedly stopped rising. Each time price approaches that level, sellers appear and push it back down. Traders call this resistance. It is like a ceiling above the market. Now imagine price returning to that level once again. Many inexperienced traders try to sell the moment price approaches resistance, assuming it will hold again. Sometimes they are right, but often they are simply guessing. The more patient trader watches what happens at that level instead. Does price hesitate? Does it struggle to move higher? Or does it suddenly break through with strong momentum and increased activity? That moment matters because it reveals whether buyers have finally overcome the sellers who defended that level before. When price breaks resistance with strength, it is not just a random movement. It is confirmation that demand has taken control. Buyers are now willing to pay higher prices than before. That is information the trader can trust more than any prediction. The same principle applies in the opposite direction. A level that repeatedly stops falling prices becomes support. Each time the market approaches it, buyers step in to defend it.